I guess I can report out a closed session, right? I can do that while we're waiting? Okay. So in closed session, the investment committee voted to revise the investment committee work plan of the board and I'm sorry, so the regular board committee and the investment committee work plans, and we'll share those at the next open meeting, so the meeting in February. So everyone in the audience can see those revisions. And I'm just waiting for Dana, so we'll tell you. No problem. Go for it. Just go ahead and request to speak.
I better start out this way.
No, it's all good. No worries.
So, as many of you know, we lost an advocate, colleague, and dear friend this week. Our former CEO, Jim Mossman. Jim devoted 22 years of his life working for teacher pension funds. He served as CEO of CalSTRS from 1988 to 2001, and upon his retirement from us, was hired to lead the National Council on Teacher Retirement, NCTR. He would spend the next decade enhancing and expanding NCTR's legislative and educational programs. He will be fondly remembered for his steadfast leadership in the pension community. I'm sorry, you guys.
Yeah, it's all good.
Jim will also be remembered for having played a key role in the development of the National Institute on Retirement Security. He believed in NERS, CalSTRS, NERS, and NCTR's missions, and was extremely honored to be actively involved in all our organizations. Jim retired in 2012 as NCTR's longest-serving executive director. We know he made many wonderful relationships along the way with his service to us and to NCTR, and we will all truly miss his presence. We ask that the members of our CalSTRS family keep his family in your thoughts and prayers. And while we know this news brings much sorrow to us all, we ask that you focus instead on Jim's many contributions to our cause and the fun times shared amongst us all, even if he was a Duck fan. Jim's wife, Caroline, and their daughter, Lisa, invite family and friends and colleagues to reflect and celebrate Jim's life and his accomplishments and services on Saturday, November 15th. That will be at the George Klump Chapel of Flowers here in Sacramento, 2691 Riverside Boulevard. Jack will be providing that information to all staff, and if any of you need to get that information from him, just feel free to contact him. And as soon as we know where donations can be made, we'll make that public also. Jack's going to make arrangements to have something put on our website. So friends for CalSTRS or friends of Jim's that look to CalSTRS for information on his passing will find that there also. I first met Jim back in the 1990s, early 90s, when I was a liaison for CTA. I was in my 30s. And I know that he was surprised that someone as young as I was as interested as I had become in retirement issues. So he took me under his wing, and I'll always love him for that. So,
Thank you. Sacramento is a small enough city that not only was Jim a prominent individual here, but we knew his family very well as well. Caroline was a long time executive here in Sacramento, so we've known them all very well. Although I followed Jim here, I really got to know him much better when he was leading NCTR this last decade. And I will say, I think something we've all learned here these last years when public pension plans have become the hot topic everywhere, there just aren't enough voices out there supporting public pension plans, talking about them, explaining why they're so valuable for retirement security. So we've lost a key voice. Jim was on point all the time how important this was, especially for the teachers of California. This was his passion and his singular focus. And that's why he wanted to stay in the field after retiring here and then going on to NCTR. But this is what he believed in night and day, and his voice was heard around the country. So we're all going to miss him. Thank you. Thank you.
thank you, Sharon.
Thank you, Dana. And we really hope to honor Jim's memory. I'm actually, your story, I feel like a lot of us have been lucky to kind of have people like that in our lives, like Jim. And I think that mentoring and looking out for the next generation is really critical. So it's great. And we kind of want to sort of end our investment committee today really with the time we have left this afternoon in his memory, and really hope to do him proud by our conduct this afternoon. So, and with that, we are going to move into business, as hard as that is. So, Anne, I believe we have a couple of guests with us, and I will beg the board's indulgence again. We might move some items around. I know we have limited time. So we have Amy Boris from CII here, and Michelle Edkins from BlackRock. And we welcome you to our CalSTRS boardroom. Thanks so much for coming and giving us some insight. I know our board is very interested and curious about corporate governance, and I think especially interested on how corporate governance enhances our bottom line at the end of the day. And I think Anne heard that very clearly earlier today. So we welcome you.
Go ahead. And just for the board and the audience's information, the investment committee, Sharon had asked that we resurrect something we used to do earlier last decade, which was have speakers come in and talk to the committee about leading investment issues. We called it the Investment Insight Program. And I am pleased to have this outstanding panel kicking that new initiative off. So as Sharon has said quite eloquently, the focus is on corporate governance. So I'm going to kick it over to Anne, and I am pleased to say both of the ladies.
Thanks. And I am pleased to introduce two of my colleagues in the corporate governance world. I will say two of the best are here with us. Amy Boris from the Council of Institutional Investors, and then Michelle Edkins, who runs global governance and responsible investing at BlackRock, so just right down the road in San Francisco. And they'll both go through a brief presentation. We've asked Amy really to focus on the domestic U.S. market, and then Michelle, because as you see from her bio, has spent time overseas, was actually with BlackRock in their London office before she came to San Francisco, and then also was at Governance for Owners, which is one of our corporate governance managers based in London. So she will bring the perspective from across the pond and outside the U.S., and then we can open up for discussion amongst the board members, any questions that you all may have. So Amy, take it away, and thanks so much for flying out.
Thank you. Good afternoon.
Amy.
Great. Thank you. Thank you and good afternoon. And it's an honor to be here. But for me, it's personally exciting. My sister Janet is a California public school teacher. She teaches at the East LA Performing Arts Magnet High School. And so I am very grateful for your careful stewardship of the assets that you manage. because that means that my sister and thousands of other educators in California will be able to retire with dignity. So thank you for the work you do. On behalf of CII, thank you for CalSTR's tremendous leadership on corporate governance generally and CalSTR's leadership in CII. The CalSTR's CII connection really goes back to our founding in 1985. CalSTRS is a founding member of CII, and I learned recently that, although he was not at CalSTRS at the time, that Chris Ailman was on our first board. He must have been in high school at the time.
I had hair.
Long hair, probably, right? And more recently, Jack Enos and Sheehan have served as our chair during pretty challenging times for CII. And we are so grateful for their time, their support, and their leadership. I will say that, not because I was invited here, but Ann Sheehan's corporate governance team really does a phenomenal job in the issues they work, but also they do a great job on their own. But they've been a real resource for CII, and I know they work very well collaboratively with other investors, and that really multiplies the impact of CalSTR's proxy votes. So it's a real advantage that they play in the sandbox very well with others. So I wanted to talk a little bit first about CII, where we come from and what we do, and then a little bit about why we exist and some of the trends we're facing in corporate governance. CII is a leading voice for corporate governance, effective corporate governance, and strong shareholder rights and protections. We were founded nearly 30 years ago by 3 visionary elected officials. California's then treasurer, Jesse Unruh, New York City Comptroller Harrison Golden, and then State of Wisconsin Investment Board Chair John Conrad. And they persuaded the heads of 21 public, union, and corporate pension funds to form CII. Now, these founders had very different views on many issues, but they agreed on a few basic premises. And the first is that investors benefit and markets benefit when corporate boards provide robust and effective oversight of management and directors are accountable to their owners, and when rules and regulations provide adequate protection to investors and ensure that important information is shared promptly and transparently with the marketplace. They also believe that investors can be have more of an impact when they work collectively than on their own. And lastly, they believe that one size does not fit all institutional investors, and as a result, it made sense for CII to focus on big tent issues in corporate governance where there is broad support, enthusiasm, and agreement. So, let's see. Nearly 30 years later, these tenets remain the foundation of CII and its work. So I thought I'd talk a little bit about what we actually do. It's really in 3 areas. They're up there on the screen. Most importantly, we provide education. We keep our members up to date on trends and developments in corporate governance and regulatory changes. We do this through our weekly member e-newsletter. We have guides to governance basics and special reports. We have almost weekly teleconferences or webinars for members on a wide range of issues from high-frequency trading to CEO pay to corporate inversions. We also have a new training course. This is something we kicked off this year, an introductory course to corporate governance. And we debuted this at our fall conference in LA. We plan to tailor this for trustees, pension fund trustees, at our spring conference in Washington. And so hope to see some of you there. Speaking of our spring and fall conferences, we have 2 a year, and they are great opportunities for our members to network with and learn from peers. Lastly, we do the heavy lifting on advocacy of corporate governance issues. We do this based on a body of member-approved best practices. And we promote these practices and policies through letters and meetings with regulators and with company officials. We do this to make sure that the shareholders' perspective is heard. Today, our voting members number about 120 pension funds, corporate, union, and public, and about a handful of foundations and endowments. Collectively, they have more than $3 trillion in assets under management. But we also have about 140 non-voting members, and they include some of the largest global asset managers, and BlackRock is one. So in aggregate, CII has its finger on the pulse of institutions with tens of trillions of dollars in assets under management. I just say as an aside that our California contingent is very large and active. We have about 40 voting and non-voting members from California. That includes 9 county funds. We would love to have more county fund members. So if you know of trustees at other funds who might be interested, we would be very happy to have them be our guest at our spring conference in Washington. It's going to be a special event. Will mark our 30th anniversary there, and we're going to have a gala dinner and invite back some of the luminaries from corporate governance years past. So happy to talk more about that. Our voting members are pretty diverse. More than half are public funds. The rest are split between corporate and union and a smattering of endowments and foundations. They come in all sizes, from a little more than $100 million in assets under management to more than $100 billion in assets under management. About a third of all shareowner proposals filed each year are by our members. There's a total of, I think, 937 shareowner proposals that were filed this year. About a third came from CII members, but only a few, relatively small number of our members do file proposals, about 20% of our voting members. Our voting members, while diverse, share a few important similarities. They have a significant stake in the U.S. capital markets. On average, CII voting member funds invest about 60% of their portfolio in stocks and bonds of U.S. companies. As employee benefit funds and heavy users of index strategies, they have a long investment horizon. That means they can't do the Wall Street walk and sell their shares if they're unhappy. And thirdly, as fiduciaries, they're generally subject to standards that require them to vote their proxies in the best interest of plan participants. As trustees, you all have many pressing issues on your plate, so it's reasonable to ask, why should you care about corporate governance? The most obvious reason, of course, is that you have a fiduciary obligation for your proxy voting, but that's not a terribly compelling answer. I wish I could say that the empirical evidence shows that proves that there's a direct link between certain corporate governance standards and practices and long-term shareowner value. But the truth is the empirical studies are mixed on that. What is certain is that corporate governance is a risk factor, an important risk factor. And effective corporate governance is a system of checks and balances that ensures or that fosters transparency, responsibility, accountability, and market integrity. And you just have to think back to events since 2000 to see how regulatory and governance failures can really wipe out value. In the early years of the 21st century, we had a torrent of accounting scandals, corporate scandals, Tyco, Enron, WorldCom. There were, these represented failures of auditors, lawyers, regulators, but their failures of corporate governance were also a contributing factor. You had abusive pay practices and imperial CEOs and weak oversight by boards. In the wake of these scandals, the Congress passed the Sarbanes-Oxley Act, which attempted to rectify some of these issues. But then the first decade of the 21st century ended, as we all know, with the global financial crisis, which itself represented a massive failure of oversight by boards as well as by regulators. I don't think I need to tell this group, relive what damage that did to jobs, to retirement security, to companies. There were enormous bankruptcies. California alone lost 1.4 million jobs between July of 2007 and February of 2010, and the unemployment rate spiked to 12.4%. The Dallas Federal Reserve Bank estimates that the cost of the crisis to the U.S. economy was conservatively $14 trillion. That's about 1 year's worth of GDP. In the wake of the crisis, Congress passed the Dodd-Frank Act, which closed gaps in market regulation, and many companies improved their corporate governance practices. But investors still need to remain vigilant. And here's why. I'm going to draw on last week's newsletter for our members, which was a special Halloween edition, which focused, we listed a bunch of corporate governance horror stories from the year. And I'll just mention a few, starting with zombie directors who continue to roam U.S. corporate boardrooms. By zombie directors, I mean directors who did not receive majority support of their share owners yet have held on to their seats. About 41 directors at 27 companies, 40 of which are still on their, failed to receive majority support, but they've stayed on their boards. And they can do this either because the boards reappoint them, or because the companies elect their directors by the plurality vote standard. So technically and legally, they're still elected. At 5 companies, more than one director failed to receive support. So I think that the worst horror story is Healthcare Services Group, where the entire board, all 9 directors, failed to get majority share owner support. It's a fundamental right of share owners to elect and remove the directors who represent them. So boards that ignore this share owner vote of no confidence essentially render the vote meaningless. Similarly, boards are continuing, at some companies, continue to ignore share owner concerns about executive compensation, poorly structured pay plans. One great example from this week was the Oracle annual meeting. For the 3rd year in a row, Oracle share owners voted overwhelmingly against a vote of no confidence, thumbs down on its pay plans, its pay practices. Larry Ellison made former CEO, he's about to step down, made $67 million in his most recent year as CEO after making more than that in each of the previous years. He owns 25% of the company, which is worth about $44 billion. Why he needs such high level of incentives is the big puzzling question. But Oracle's not the only one. Neighbors Industries, which I think has been a CalPERS target company, and Tudor Perini have lost their say on pay votes for 4 years in a row. Boards are also, this is kind of a new twist. What we're seeing now, boards are trampling share owners' rights in a new area, changes to bylaws, and kind of dark of night changes to bylaws, if you will. On Monday, Imperial Holdings, it's a Florida company, adopted a bylaw requiring that any shareholder who wants to sue the company for certain cases has to get the consent of 3% of the outstanding shares in order to file suit. The company did not seek shareowner approval for that bylaw. And Bank of America, just last month, unilaterally changed its bylaws to be able to combine the role of CEO and chair. And this essentially unraveled a binding 2009 shareowner proposal that had won overwhelming support from shareowners to separate those roles. And not only is this flouting the will of shareowners, as Ann Sheehan said publicly, it's just also a really bad move. When you think about it, the CEO runs the company, the chair runs the board, which oversees management. When the CEO is also the chair, there's an inherent conflict of interest and really no real ultimate accountability. I could go on. There's plenty of examples of that, but I think that's probably enough. The Supreme Court of Delaware, though, deserves special mention on the bylaw front. In an opinion issued in May, it allowed boards to approve so-called fee-shifting bylaws. These require investors who sue and lose to pay not only their costs, but the company's costs as well. And while the case in question in Delaware applied to, it was specifically about a nonprofit, legal experts think that the ruling also applies to stock companies. And in the wake of the ruling, more than 20 companies have adopted these fee-shifting or loser pays bylaws, which one law professor has referred to as a nuclear weapon against shareholders because they can really discourage investors from bringing suit. My last example of a horror story is the U.S. stock exchanges, which sadly have really let shareholders down. The New York Stock Exchange earlier this year let Alibaba list its IPO shares, even though the company has a very shareholder-unfriendly structure. Control is in the tight group of insiders who have the exclusive right to nominate majority of the board seats for directors, and they can appoint them regardless of whether they're supported by the shareholders or not. In contrast, the Hong Kong exchange, the reason the Alibaba came to the New York Stock Exchange was because this Hong Kong Stock Exchange said, no, we can't let you list here because your nominating structure violates our one share, one vote principle. I'd like to turn now to some hot trends for 2015. Oh, didn't go? Okay, great, there we go. And these are really kind of, it's not so much trends for 2015 as evolutionary trends that are happening in corporate governance. If you think, I always think of corporate governance as it's a marathon, not a sprint. So these aren't really hot issues so much as trends that are going to become more
Chris says
pronounced.
that about the portfolio.
Oh, okay, good, I'm in good company.
I know that.
For the first is that corporate governance has gone mainstream. And, you know, what do I mean by that? Many CII best practices that were once viewed as radical are now commonplace. In the S&P 500, companies in the S&P 500, 80% have adopted majority voting for directors in uncontested elections, and around 90% elect directors annually. They've gotten rid of staggered boards, which are entrenchment mechanisms. And corporate governance is, frankly, no longer a fringe issue. Traditional asset managers are very involved and take this very seriously. The fact that Michelle Edkins is here from BlackRock speaks volumes. But it's not just BlackRock. Vanguard this year sent letters to 350 of its portfolio companies asking for very specific improvements in corporate governance and did engage on those issues. Last week or last month, the CEO of Vanguard gave a talk about why corporate governance is so vitally important. And he cited six principles, corporate governance principles for Vanguard that are quite similar. Many of them overlap with CII best practices. If you step back, I think this reflects sort of a long-term shift in who owns stock in America. Back in 1980, or 33 decades ago, most of the shares were held by individuals. Today, institutions own more than 50% of shares outstanding, and at some of the largest U.S. companies, 70% of the stock is in institutional hands. And institutional investors, many of them, view their ability to influence governance as a key way to mitigate risk and drive value. Another kind of overarching trend I see is that investors the investor's toolkit for influencing governance is changing. It's expanding. And one sign of this is that engagement, talking, meetings, letters, phone calls, whatever, between companies and their investors is starting to eclipse shareowner proposals, at least in the governance arena. 15 years ago, filing a shareowner proposal was practically a required door knocker. It was the only way to get a company's attention. Today, companies themselves are reaching out and engaging, making phone calls, inviting shareowners to come in and talk. Engagement is, quote unquote, the new normal, if you will. And investors are achieving progress more through quiet diplomacy than, ballot box battles. I think Say on Pay has been a real catalyst for this. These advisory votes on executive compensation were mandated by the Dodd-Frank Act. And what's happened is that it's clear CEOs and boards really care about these votes. And as a result, companies are reaching out to their investors and making directors available to talk to investors. And that willingness to talk is starting to ripple over into other issues. One example of how that's benefiting shareholders really comes from CalSTRS itself. It's on CalSTRS' work on majority voting for directors. CalSTRS wrote letters to 93 companies. 53 agreed to adopt majority voting for directors in time for CalSTRS to withdraw its shareowner proposal. And at 33 of the companies, CalSTRS didn't even have to file a shareowner proposal because the discussions worked and companies agreed to make the changes. I think the exception to this is really, in the governance arena, is proxy access, which is the right of shareowners to nominate candidates for board seats in the company's proxy materials. This is perhaps one of the most contentious issues in the business community. Yesterday, New York City pension funds filed proxy access proposals at 75 companies. I know CalSTRS and other public funds have supported this. We'll see how it goes. I do think, though, we could be maybe poised for a breakout on this issue. Already, some large U.S. companies have agreed to adopt proxy access mechanisms. 4 companies this year, bringing the total to 12. So over time, there may be some change here. Shareowner proposals, though, as a group, have really been overshadowed by a different trend, and that is the surge of activist investing in the work of activists, mainly hedge funds, buying stakes in U.S. company and using those stakes to press for change, either in strategy, capital allocation, or on the board. There are, a confluence of trends sort of making this happen right now. You've got record levels of cash piling up at companies, influx of funds from investors looking for higher yields, and frankly, growing acceptance by pension funds of activist investing as a strategy. And again, CalSTRS has been doing really groundbreaking work in this area by its relationship, in its work with relational investors, teaming up at Timken and I believe with other activist investors. I think this trend is likely to continue, but we may be nearing a high water mark as more money flows into activist funds. Activists themselves have to put that to work, and that may mean some focus on more dicier target companies, and that could mean lower returns. So you might see a little bit of shakeout. Back to the issues that Sharoners are focusing on. I think one thing we're seeing is that there's the growing prominence of social and environmental issues. This year, the group of Sharener proposals that were most prominent were not really classic corporate governance. They were proposals focusing on disclosure of corporate spending on political campaigns and lobbying. 132 were filed, 92 came to a vote. 6 won majority support. I know that it's not up there, but on the environmental side, proposals dealing with climate change have also been quite popular and prominent this year. On the governance side, I think the main focus now and going forward is likely to be on issues surrounding on the composition of the board. This is a kind of bucket of issues that includes diversity, and diversity broadly, not just women on boards, but racial diversity, ethnic diversity, and more broadly, diversity of experience and skills. Board tenure and the local buzzword board refreshment, issues of trying to get some turnover on boards, getting boards to think about, do they have the right people, is also part of this. And this is one reason why investors are pushing for more disclosure by boards of the way they evaluate themselves and board succession planning. It's a telling sign. It will give some indication that the board is actually thinking about its composition. All of these issues are focused on making sure the right people are sitting at the boardroom table. I'll stop there. I don't think I need to discuss those issues in more detail because I think these are some of the very corporate governance issues that okay, that Anne and her team are very deeply engaged in. So with that, I will pass to Michelle. I'd be happy to answer questions later.
And Ms. Edkins, I think what I would ask is, we have probably about, we have about 10, 15 minutes left for your part because we do have kind of a tight schedule today. But I wondered if you could focus your conversation, because, you're from BlackRock. I think the conversation we had this morning with our board really is about, we kind of know about corporate governance partly because of Anne's leadership on our staff. I think for us as board, what we really want to hear about is, how does it affect our bottom line? Are there examples that you can give of ways that it has in other funds that you've seen or other institutional investors that you've worked with? And kind of more focus your comments maybe on that, because I think that's, we care about the issues and we love CII, but I think for us as fiduciaries sitting on this board, we're really wanting to know how is corporate governance helping our bottom line in terms of making our returns and helping make money for teachers' retirement here in California. So welcome, glad to have you.
So I will definitely focus my remarks on that area, but I'll just give you a little bit of context about BlackRock, and in particular why we have a governance function, because I think it leads into the question you asked. So I head up BlackRock's corporate governance and responsible investment team, as Anne mentioned. we see ourselves, because we are also a fiduciary investor, we only invest on behalf of clients, as having a very high standard of fiduciary duty to those clients. And we see the corporate governance function that my team fulfills as being part of meeting that fiduciary duty to protect and enhance the value of our clients' assets. And some of that is informed by the fact that the vast majority of the equity investing we do is through indexed strategies. So our clients, by definition, are long-term, locked-in investors, as you know, because you've got a very similar strategy. Being long-term on behalf of our clients also means that we have the motivation, but also a responsibility to engage with companies, to monitor how well they're doing. And when we talk about corporate governance, we're not looking at this as a compliance function. It isn't that companies necessarily have to follow our policies. What we're trying to assess through our corporate governance engagements with companies is how well they're led by the board and how well they're managed by the executive management. And there isn't much empirical evidence, as Amy's already mentioned, to prove that good governance leads to better long-term returns. But I think no one would try and refute the common sense argument that if you have good leadership, you're likely to be taking better decisions, implementing strategy better, foreseeing risks better, and recovering when the natural sort of events that occur during a normal course of business sort of throw the company off course for a little while. And so from that perspective, we look at governance as both a risk mitigation factor, but a quality factor as well. And so some of the work that we do, and I'm probably going to end up hopping around a little bit because you asked me to focus, but some of the work that we do, particularly in relation to the index portfolios, is we have a proprietary model that we use to rank companies or rate companies on environmental, social, and governance factors, as well as financial performance. And when you look at a whole index, you identify the bottom performers against their peers, and we focus on those companies for engagement. Because again, looking at it from an indexing perspective, if you can improve the quality of leadership at the bottom decile or the bottom quartile, arguably over time, you're going to move the performance of the whole index up. And so we do, by nature of our work, and I'm sure Anne's mentioned this to you in the past, we tend to end up focusing mostly on laggards and underperformers than on the companies that are doing extremely well. Although our engagement program is broader, and we'd like to talk to high-performing companies to understand what dynamic there is there that has led to that high performance, so that we can perhaps extract lessons for both our own knowledge and for imparting more generally to other companies. So the way that my team is considered within
I
Black...
apologize for interrupting, but we do have a question.
Oh, yes,
And
please.
it's for Amy, Michelle, anyone can respond to it, but it's in line with what you were just speaking about, Michelle. Can you talk about maybe the 2 or 3 characteristics or qualities that you see or can identify in a well-functioning, high-functioning board, what you look for in that boardroom, and how that those characteristics actually lead to better performance over time?
I would say that the first and foremost is a board that recognizes it's accountable to shareholders, that it's not their company, it's not the management's company, the company is owned by another party to whom they are accountable, and that there are mechanisms in place to ensure that that accountability is a real thing.
So for our purposes, our shareholders would be the teachers of the state of California, right? Not our elected officials, but it's their.
Who
it's
are you
their
responsible to? Yeah, and who do you report to on your activities and your effectiveness?
Or the educators, there's
Yeah.
administrators as well, educators in California.
I agree. I would just add that I'm sorry. Thank you. I agree. One other thing, I think investors look for real disclosure about how the board evaluates itself and its needs. Evaluates whether the people sitting around the table fit the company's strategy. Is this a board that's thinking hard about, does it have the right people there? And that you only see through, we can't be inside the boardroom, but that takes real disclosure of the way the board evaluates itself and the way it thinks about succession planning.
And for our purposes, obviously, we're in a public domain, so we are subject to disclosure that, private boards are not, they're
Right.
not forced to, they're not required to.
No.
So we operate in that public arena already.
Right, but US companies don't have to. Although in other countries, they do. I mean, there are plenty of countries in companies in Europe and in Canada who have to make some of those, have to disclose some of that information.
Is there a third? So it's disclosure, also being accountable to shareholders. Is there a third quality?
It's sort of one of those things that you know it when you see it, which isn't always
Right,
that helpful.
that's the famous
Isn't that
Supreme
excellent?
Court
It's,
quote.
it's board members who are engaged, have relevant experience, they're looking to the future, they know they're not, there's no hubris or very little hubris in the way that they operate. They know that there are other people who could do the job if needed, and they're willing to step down and act in the interest of the company as needed. And this is why I think we have to be very mindful that corporate governance guidelines are a sort of a benchmark, but they're not the be-all and end-all, because really good governance, good leadership is behavioral. And that's why you know it when you see it, because you can have a board that looks absolutely perfect on paper, but when the boardroom door shuts and the behavior goes completely array, then you know that this is not a well-functioning group, and therefore they're not going to be taking good decisions. And so there's an alchemy about it that is very hard to pinpoint. And I think the imperfection in the system, if you will, is that because we're operating from the outside in an arm's length, we do have to use certain proxies to assess quality. So what are the company's disclosures about who's on the board and what they bring to the board and so on. But through monitoring that performance and meeting with management and meeting with board members and trying to assess that for ourselves, I think you get quite a good idea about whether it's working or not. And I think to answer your question about the financial impact, the bottom line impact, sadly, in our world, again, you nearly always see it in the negative before you see it in the positive, in the sense that when it's going badly wrong, usually there's a very significant loss of financial value, and often we have to wait until that point in time to be able to push for the change that we've known for a long time is necessary, but you don't have a lever until things go badly wrong.
In the world in which I operate in public education, there's a lot of discussion about do additional resources actually improve schools. I think there's a lot of evidence that shows a lack of resources hurt schools. More resources may help schools if used properly, but if you don't have the resources, you're going to hurt kids and hurt schools. So it's kind of along the same lines. Yeah.
And this is why we believe that it's important to have a broad-based and continuing governance program, because the sexy things that come up through shareholder activism or when there is a big splash in the business pages, those are usually a sign that things have been quietly going wrong over time. And so continually chipping away at improving practice, reminding boards and management who they work for. So, BlackRock as a shareholder on behalf of our clients as beneficial owners, is how you reduce the number of those sort of train wrecks, if you will, and really try and push for the practice all the time.
Excellent.
The other thing I was asked to talk about, and I'll go through it quickly because I recognize you've got time, I really will, is just a little bit of a compare and contrast between the US and practices elsewhere, because I understand you might be looking at sort of expanding more in what you do outside the US. And as you can probably tell, I'm not from the US. I moved to San Francisco 3 years ago with BlackRock. And I think there are a couple of fundamental things that are really, really different and are gradually changing here, or actually relatively quickly changing, but they feel gradual when you come from somewhere else. And underpinning it is really a different philosophy about what the equity market is for. And there is academic research around this point, and I'm going to have to do it very simply, but in a lot of the rest of the world, the way that the relationship between companies and their investors is structured is an ownership structure. And the rights of shareholders as partial owners of companies are usually in corporate law, and they're steadfast and they're really quite robust. In the US, the way that I have been taught to understand the way the market was developed is that it's all focused on market efficiency. And this puts a lot of power, if you will, in the hands of the board and the management. Neither is necessarily right, and they both come from different historical sources. But why this matters in governance is that you don't see as much shareholder activism in the rest of the world, in large part because shareholders have more rights, which they use more subtly. They have better relationships with management and with boards who are more responsive to shareholder concerns. And this creates, if you like, a virtuous cycle. And I think one of the biggest changes in the US that you're really seeing impact that relationship between boards and management at companies and the shareholders is majority voting. Because for the first time, probably in the whole period of recent market capitalism, of managerial capitalism, board directors recognize that the shareholders can remove them if they don't act to protect the interests of shareholders. Up until that became a reality, I think it's fair to say that most directors felt a stronger affiliation with the management, and particularly with the CEO, who generally appointed them to the board. And it's a very different way of looking at the world in terms of accountability, and I think it's a hugely important one.
Thank you. Thank you for that. Any questions from board members?
I think I know we're running out of time, but Michelle, when you look at the world, what are some of the hot spots geography-wise that we should focus in on in our efforts?
Well, Chris will probably laugh to hear me say this, but I think Japan is really interesting right now. But I was just there 3 weeks ago, and the way that our teams are structured, we have a 20-person team, but it's broken up regionally, and people are on the ground in the region. So I have a team in Tokyo and spent some time with them and out visiting with government ministers and so on, ministries, I beg your pardon. And there really is a focus on governance, and again, this accountability to the investor as something that will change behavior in boardrooms and in C-suite, because there is a real need for enhanced financial performance of Japanese companies to kickstart the economy. And so I think that is very interesting. The other thing that you're seeing a lot moving around in other markets is what is called stewardship or stewardship codes, which are refocusing, if you will, the corporate governance debate on the investor and the responsibilities of investors. Because a good governance structure only works if the people to whom the boards are accountable are doing their part of the job. And so that is the monitoring, that is the engagement, that is working with other shareholders to ensure that, everybody is collaborating at some level and forming consistent opinions. And so I don't imagine that there will ever be a stewardship code in the US, but it is something that you're seeing coming reality just in practice in any case without the need for a market level code. And then the other things that are very similar to here really, the focus on boards and the quality of the people on the boards and the effectiveness of that group. Compensation is a big issue in many markets, and you're probably aware that in Europe there are caps on pay for financial institutions, and that's been a very interesting experiment in why governments shouldn't get involved in pay. And then, again, social and environmental issues, not as shareholder proposals, but as a topic for conversation between long-term investors and company management, because these things are financial when you're looking over multiple time periods. I would say those are the main things. Oh, and the really topical thing that causes a lot of ire in the US in particular, but increasingly in other markets, is the influence of proxy advisors. You hear it everywhere now.
Wow. Well, thanks so much for your time. And I know Anne's going to be presenting more about our corporate governance in April at our April Investment Committee meeting, but I really do appreciate it and echo, the thoughts about CII, where I think Harry and I are both planning to attend in the spring, so we'll see you there, and we really appreciate the work that CII does, and we look forward to partnering Michelle together, and thanks so much for your time and energy. Appreciate it.
Thank you very much.
We're going to move on to item 9, which is our CIO report. While Chris is getting ready, I wanted to just, a point of personal privilege. We had a board dinner last night, and we celebrated our beloved Mary Miles as she celebrates her retirement, and that was great. But there was another person there who had his last board meeting yesterday and was sitting in the audience today, but then left before I was able to say this. So I just wanted to give a shout out to Robbie Beegler. He did sneak off before we were able to embarrass him in public, but Robbie has been sitting in on our board meetings as a representative of the treasurer, and I think the board really appreciates. Robbie is so funny, and but he's so smart, and he cares so much about public service, and so we just wish him well. He's moving down to our neighborhood in Los Angeles, and so I'm glad that it's not the last I've seen of him. But we just want to give a shout out to Robbie. If you're watching, we just really appreciated working with you on the board, and wish you all the best in LA.
He's under the map.
And Robbie, if you're watching, Harry said the key's under the mat, so just FYI. All right, Chris, take it away.
Thanks very much.
He's going to take it.
Here's the report for November. I know the teachers in the back of the room always want to know the assets. Assets are at 187 billion. So we're actually down below where we were at June 30. But again, as I think I brought up in the summer, we have a positive return. And that's an evidence of our negative cash flow. So we ended June 30 at 189. We're now at 187, but we're up about 0.5% fiscal year to date. Obviously, quick math through October, that is a third of the year. So now we need to make 7% in the remaining 2/3 of the year. So we have the pressure before us. I think it will be a very tough year, as evidenced by the market. Here's the asset allocation as of unaudited as of the end of October. As you can see, we stay pretty close to our targets. We're just about market weight in global equity. We're underweight in fixed income, and we've been a little high in cash, and we've been talking to the board about that. Our cash position helped us out a lot in the first 3 months and halfway through October, but in the last 2 weeks, obviously, it's worked against us. So here's a quick chart of the U.S. equity market since June 30, just this fiscal year. You can see the big sell-off in the middle of October, and then suddenly the massive reversal. So we closed today, actually I'm not sure where we closed, but we were trading up at as high as I believe 2020. Trading flat, there we go. But we were 2020 on the S&P 500, yeah, 2030 on the S&P 500. And I mentioned to the board there was only one economist a year ago who thought he'd be clever and said, oh, well, the S&P is going to hit 2014 in 2014. Well, lo and behold, they were right for the first time as of last week. Now there are only 2 economists that ended up predicting that. But I don't know if anybody's predicting 2015 and 2015, but that's pretty lame because we're already there. So here's a longer term view of the market. This is going back to 2009. So just about the market lows. And you can see just the massive uptrend in this market. And it also helps put this last volatility into kind of perspective. We have seen this before. We've had volatile periods, but we went through a pretty benign last couple of years. So now we're back to more of a hiccupy type of market. So I got these sage comments, which I thought were so spot on. I had to put them on the up for you. And actually, the word sage commentary doesn't pop up there, but it is true. We had a very solid, nice GDP. Unemployment today was reported as going down 0.1%. You're creating jobs. The U.S. is the best neighborhood. And as it says, the quote at the bottom, the market's almost up 10%. The world's not coming to an end. But my challenge is, who was this from? Wasn't Bill Gross. Wasn't Cashman at the floor of the New York Stock Exchange. It's an email I got, I think, on Monday from none other than Harry Keeley, chair of the board. So Harry is a budding economist, but I just thought these ideas were spot on with what we're seeing and where we're at. So, there's the sage commentary. So here are your valuation indicators. Again, these come out in your quarterly report, but I thought I'd give you a quick snapshot to really show that, as PCA has reported, in some cases we're close to the red in terms of valuation. Private equity is a little rich, very rich right now. I would say real estate's kind of tight and pretty pricey in certain markets. But the equity markets, despite the run-up, aren't in the overvalued range. It's really bonds and the private markets that look pretty darn tight and pretty darn rich. And so when we talk about cheap and rich in the markets, cheap being that it's a good bargain, and rich being that it feels like pretty overpriced and pretty hard to buy. So it's interesting in this dynamic, you would continue to buy equities even though it's a tough place to be. So let's go up in the crow's nest and look out on the horizon. You know, the risk, which we spent a lot of time at the board talking about, is the considerable time. When's the next rate increase coming? What does that mean to the market? I would say the only thing I've added on the global risks, obviously earthquake and droughts are a big problem. Sunspots suddenly popped up as a problem about a month ago. But we're coming into the winter season, so we're really going to have to see how storms have an effect, because we certainly have had stronger storms. But it's interesting with all the focus on the U.S. election and the equity market, Russia, Ukraine, North Korea, all that stuff has really dropped from the headline, and everybody's been focused on just Ebola and the risk of Ebola. So on the positives, those have not changed, but I think that is important. Rates are near zero, and as we discussed with the board, rates may well stay near zero. So that wraps up my report. I just want to emphasize to the public, we have in-depth quarterly reports and annual reports available on the investment portfolio. These are the freshest, newest data, and they are available on the .com website. We also are posting videos now for the public about the asset classes on the .com website. So if you always want close information, that's the place to go. CalSTRS.com under the investment tab.
I'll
Questions?
just give a plug for that. I mean, we watched the videos that Chris and his staff put together, and so I do highly recommend that the public check those out. They're really short, you know, they're 3 to 4 minutes or so, and you can download them on your phone and watch them while you're, you know, waiting in line somewhere. But I think they're really informative, so thanks. Thanks, Chris. Any questions from board? Seeing none? Okay. Thanks, Chris. Item 10, approval of the minutes from September 4th and 5th Investment Committee, our open session. And you have the corrections, Lamont. So it is an action item.
So moved.
Second.
All those in favor say aye.
Aye.
Opposed? Abstentions? Great. So items 11A and B are consent information items. What I'm going to ask, Ann, if it's okay, if members do want to pull anything, usually with consent items, unless you want to pull them, what I might do is, for time, there are a couple questions I had, but I'm going to put them into the April meeting and ask when we focus on sustainability. Sound good? Any other questions? All right. Is that okay?
So they're
So-
coming back in April?
So but they're consent information, so just if you want them pulled or items in the report pulled. Item 12.